The housing market isn't just about first-time buyers and investors anymore. Right now, a record-breaking $14.39 trillion in senior housing wealth, as of Q2 2025, is on the line. Goldman Sachs just coined the term financial vortex for a reason, and it's hitting retirees harder than ever. Are these homeowners, who've been told for decades that their home equity is their retirement nest egg, walking into a trap? We're seeing more and more retirees trying to use their homes to bridge the gap in their savings, especially with interest rate cuts looming as early as September 2025. But what happens if the market shifts? What happens when their home is their only lifeline? Let's break down the hidden risks, the new economics of retirement, and what this all means for the real estate market moving into 2026. All right, let's talk about the silent shift happening beneath the surface of the housing market, one that's got profound implications for millions of Americans right now. Because if you thought that higher for longer interest rate environment only pinched new buyers, think again. As of late 2025, we're seeing an astonishing $14.39 trillion in housing wealth held by senior homeowners. That's a 4% jump in just a year, driven by those appreciating home values. But here's the kicker. A significant chunk of that isn't just sitting there. Goldman Sachs' latest Retirement Survey and Insights report introduces this concept of a financial vortex, where debt service, healthcare, and yes, housing, are eating up more of income, leaving retirement savings dangerously thin. In fact, we've seen the percentage of U.S. households over 65 with mortgage debt climb from 38% in the late 80s to nearly half today. It's creating a scenario where, for many, their home isn't just a place to live. It's become their de facto retirement account. And as the Fed hints at rate cuts, potentially by September 2025, how does that really reshape the landscape for those banking on their biggest asset? We're diving deep into exactly how this plays out, the risks, the opportunities, and what it means for the senior living market and, frankly, everyone else. Percent year over year, a significant jump according to data meticulously analyzed by Reg's blog, a respected financial commentary site. This isn't merely an uptick in a statistic. It signifies a profound, systemic shift in the very fabric of American retirement funding. For millions, their home equity has transformed from a passive asset into the dynamic cornerstone of their financial strategy. Investment banking giant Morgan Stanley, in their comprehensive February 2024 Retirement Landscape report, explicitly highlighted how a primary residence's equity now frequently represents the single largest component of a retiree's net worth, often eclipsing 401(k)s and traditional IRAs combined. This phenomenon, which we've termed retirees banking on home, is gaining momentum precisely because conventional retirement savings vehicles are proving woefully inadequate for a vast segment of the population. A revealing Bank of America survey from December 2022 unequivocally confirmed this trend, finding that a staggering 70% of homeowners aged 45 to 76, encompassing the entirety of Gen X and the baby boomer generation, are increasingly viewing their accrued home equity as a primary, indispensable financial resource for their golden years. Consider the sobering reality. If you're among the substantial portion of Americans with less than $1,000 saved for retirement, as exposed by a 2023 Federal Reserve study, the impressive $14.39 trillion in collective senior housing wealth, a figure reported by the National Reverse Mortgage Lenders Association in Q4 2023, starts to look less like an optional luxury and more like an absolute lifeline. It's not just a nice-to-have. It's an absolutely critical piece of the complex retirement puzzle. However, this escalating reliance on home equity, while pragmatic for many, is certainly not without its own distinct set of risks, especially when we factor in America's ongoing retirement savings crisis. Now, this growing reliance on home equity isn't happening in a vacuum. It's a direct consequence of a deepening retirement savings crisis across America, a systemic issue with far-reaching implications. We're witnessing alarmingly low savings rates, pushing millions into precarious financial positions. Consider this stark reality. A report cited by Clever Real Estate in January 2024 revealed that a staggering 62% of retired Americans believe the U.S. is currently in a crisis state regarding retirement finances. Within that group, the data highlighted disturbing examples, with some retirees, like a hypothetical Eleanor from Ohio, having as little as $1,000 saved. Think about that for a moment. A mere $1,000 to last through potentially decades of retirement, covering everything from groceries to unexpected medical bills. This isn't just anecdotal. A December 2022 study by the National Institute on Retirement Security, leveraging extensive U.S. Census Bureau data, painted an even starker picture. 37% of working-age Americans, or nearly 57 million people, lack access to any employer-sponsored retirement plan, such as a 401k or 403b. The median savings among all working-age Americans in that study? A shocking $4. Yes, $4. While likely a statistical quirk highlighting extreme inadequacy across a broad demographic, it unequivocally underscores the systemic failure of traditional savings models for a huge swath of the population. Goldman Sachs Asset Management's recent 2025 Retirement Survey and Insights report directly addressed this critical juncture, coining the term financial vortex. This isn't about individuals failing to save. It's about household income being increasingly consumed by rapidly escalating housing costs, soaring healthcare expenses, persistent debt service, from student loans to credit cards, and the growing burden of caregiving for aging parents or adult children. Goldman Sachs challenges the conventional wisdom that people just need to save more, arguing that profound structural shifts are rendering traditional financial advice insufficient for many. For countless seniors, their home equity isn't a bonus or a luxury. It's the absolute last line of defense against this vortex, making their mortgage situation in retirement more critical than ever before. Retirement with mortgage debt, a significant and concerning shift from past generations. This isn't merely an anecdotal observation. Robust data from the Center for Retirement Research at Boston College clearly illustrates the trend. The percentage of U.S. households over age 65 carrying some form of debt has surged from a manageable 38% in the late 1980s to an alarming 60% by 2019, with mortgage debt being a primary component of this increase. This substantial rise has a direct and detrimental impact on financial flexibility, often trapping retirees in a cycle of reduced cash flow. While the Equal Credit Opportunity Act, ECOA, explicitly prohibits age discrimination in lending, older adults frequently encounter subtle, yet significant hurdles. They can face higher rejection rates for new mortgages or refinances due to factors like limited fixed incomes, reduced earning potential, or existing debt loads that lenders perceive as too high. For instance, a detailed issue brief from Nati Imorn-Sirapanich published on March 14, 2023, by the Urban Institute, explicitly highlights that older mortgage applicants are considerably more likely to be denied. Furthermore, even when approved, they often secure less favorable terms, leading to higher interest rates and increased overall costs for their mortgages. Consider a hypothetical retiree, Eleanor Vance, aged 72, living in Phoenix, Arizona, on a fixed income primarily from Social Security and a small pension. She might wish to refinance her home to lower her monthly payments and free up cash for rising healthcare costs. Despite a flawless 30-year payment history on her current mortgage, her current income-to-debt ratio, perhaps amplified by a recent medical expense, might flag her as a higher risk to lenders. This could lead to a denial or an offer with an interest rate significantly higher than younger applicants with similar credit scores but greater earning potential. This stark reality forces many like Eleanor to carry substantial mortgage debt well into retirement, severely impacting their cash flow, limiting their ability to weather unexpected expenses, and diminishing their capacity to truly enjoy their golden years. This growing debt burden is fundamentally changing how retirees interact with their most significant asset, their home equity, pushing many to reluctantly explore alternatives to unlock that trapped equity. Debt now represents the largest component for many retirees. It's a seismic shift, forcing a fundamental reevaluation of how retirement is funded, especially when you consider that a home often remains a retiree's single biggest asset, as highlighted by financial planner Chris Kawashima in Charles Schwab's July 2025 Retirement Realities article. This isn't just about carrying a residual mortgage. It's about actively tapping into that accumulated home equity. Senior Loan Officer Paul Senapani, writing on March 31, 2026, for Retirement Strategies Daily, precisely detailed how retirees can qualify for home equity loans using reliable income streams like Social Security benefits, defined benefit pensions, or even consistent 401k and IRA distributions. This means that significant wealth, once largely illiquid, can now be accessed for myriad needs, from unexpected healthcare costs like a sudden medical procedure to covering essential daily expenses or even funding home modifications for aging in place. For example, imagine a retired couple in the Phoenix metro area, perhaps the Millers, who own a paid-off home valued at $600,000, facing a sudden, unexpected roof replacement costing $15,000. A home equity loan provides a direct, efficient path to fund that critical repair rather than depleting their limited liquid savings or investment accounts, which might trigger capital gains taxes or missed market upside. However, Senapani also warns of the significant inherent risk, creating new, potentially long-term debt during a period of fixed income. Dan Hunt, a wealth management advisor from Morgan Stanley, in a February 13, 2024 piece titled The Evolving Role of Home Equity, underscored this broader trend, noting that drawing down home equity, whether through a home equity loan, a HELOC, or a reverse mortgage, reflects a growing willingness among retirees to leverage this substantial asset for immediate retirement living expenses. This fundamentally challenges the traditional view of a home as purely an asset to be passed down to heirs. Instead, it's increasingly being repositioned as an active, dynamic financial tool for later life. But this approach, while offering a critical financial lifeline for many, also ties retirees' long-term financial well-being directly to fluctuating interest rate environments, adding another layer of complexity to retirement planning. Gauge, but about the rapidly shifting landscape of interest rates and how that impacts every aspect of retirement planning. The Federal Reserve, after a protracted period of higher for longer, that saw the federal funds rate peak at a 22-year high of 5.25% to 5.50%, now appears poised to cut rates, with market analysts like those at Goldman Sachs predicting the first move potentially at the FOMC's September 17th to 18th meeting. This isn't just a fleeting headline. It's a monumental economic shift from an era where borrowing costs, like average credit card APRs hitting a staggering 25.13% in August 2024 according to the Fed, made any non-mortgage debt truly punitive. For retirees, or those nearing this critical life stage, this monetary policy pivot could open critically important financial doors. Lower interest rates directly translate to more attractive and affordable home equity loans, HELs, and home equity lines of credit, HELOCs. Consider Mrs. Henderson in Scottsdale, Arizona, a recent retiree who, after a year of agonizing over a 7.5% HELOC offer from her regional bank in late 2024, might suddenly find herself looking at a far more manageable 6% or even 5.5% rate in early 2026. This isn't merely about shaving a few percentage points off an interest payment. It's about making the strategic decision to tap into that accumulated equity, financially viable for necessities such as unexpected medical expenses, essential home modifications for aging in place, or even just bridging a temporary cash flow gap. This significant shift in monetary policy can dramatically impact both the cost of accessing that record $14.39 trillion in senior housing wealth recorded by the National Reverse Mortgage Lenders Association in Q2 2025 and the overall health and liquidity of the real estate market. This brings us to the broader implications for the market itself. The real estate market, a shifting landscape for seniors. Now, this shifting rate environment plays directly into what Reg's blog, authored by Reg, in late 2025, highlights. the critical link between the residential real estate market and senior living sales. As 2025 draws to a close, we're seeing a significant slowdown. U.S. homebuyers in November were at 1,425,100, the second lowest level in 12 years. This market slowdown isn't just a headline. It could profoundly impact a retiree's ability to sell their home quickly or at their desired price if they need to relocate or downsize. Think about it. An 80-year-old seller, according to research from the Federal Reserve Bank of Philadelphia, typically sells for less than younger counterparts. While Americans age 70 and older collectively hold a staggering $13 trillion in housing wealth, as Redfin's March analysis highlighted, overestimating that home equity as a retirement safety net is a real risk, warned by the New York Times. What's more, over 75% of older adults strongly prefer to remain in their communities, with an equally large percentage hoping to stay in their current homes. This aging-in-place trend, driven by financial constraints, emotional attachments, and a desire for independence, means fewer older adults are selling at all. This creates a fascinating dynamic, one that PwC's Emerging Trends in Real Estate report has already identified as senior housing, a new driving force. It recognizes this demographic's growing impact. We're seeing a structural shift where a significant portion of the housing stock remains locked up, while those who do need to sell face a less liquid market. It's a complex picture that demands careful navigation, especially as retirees increasingly rely on their largest asset, line. Now, this isn't merely a headline. It's a fundamental recalibration of the financial landscape for millions. The record $14.39 trillion in senior homeowners housing wealth in Q2 2025, up 4% year-over-year, clearly shows homes are now acting as a de facto retirement account for many. As Goldman Sachs Asset Management's Retirement Survey and Insights Report 2025 illustrates, the traditional save more advice is increasingly outmatched by the financial vortex of housing, healthcare, and debt, making home equity an indispensable component of retirement solvency. However, this reliance comes with acute risks, especially for those entering retirement with new mortgage debt in an uncertain rate environment. Are you considering using your home equity in retirement, or have you already? Share your experience in the comments below. Specifically, what financial factors drove your decision, and what impact did it have? If you want to stay ahead of these evolving real estate trends and understand how they impact your personal finances, hit that subscribe button. And if you're wrestling with the thought of taking on debt in retirement, you absolutely need to watch my detailed breakdown on the lock-in effect. Why boomers can't sell in today's market, where I dive deep into how existing mortgage rates are trapping homeowners, and what that means for inventory and pricing in 2026.